Well, I'd like to welcome everyone today to our first podcast, Through the Noise, with Cam Harvey. I'm Robert Olinger. I'm an assistant dean here at the Fuqua School of Business and an alumni, and I'm very much looking forward to our conversation. So first, Cam, I was delighted to be invited to do this with you, and I'm curious, what was the motivation behind getting this going?
The main motivation is my social media, where so many people have reached out and asked, why aren't you doing a podcast? So I wanted to do something a little different. So the podcast is very short, and I think that's important. And it's also kind of consistent with my postings on LinkedIn and X. It's unconventional. So I will be challenging conventional wisdom, and it's definitely not scripted. I really want just a conversation with you.
Okay, that's great. I have a question. The markets, are they overvalued?
It's definitely unscripted. So, I can't give investment advice. Well,
then let me rephrase it a little bit. Are we partying like it's 1999?
Wow. Okay. So I think I can go there.
Okay.
And I've thought about this a lot. I was definitely there in 1999. So I think that there are at least 5 fundamental differences between today and 1999. So 1999 was kind of the peak of the tech bubble, and it burst in 2000. And a lot of people believe that we are in that situation today, that there's great downside. The stock market could collapse, and that could cause the unraveling of the economy. And indeed, in 2001, we had a recession. So let me go through the reasons. So number one reason is the technology is fundamentally different. So back in 1999, it was the internet. So the internet had been around for quite a while, but it really caught on with kind of the browsers in the early 1990s, and then the run-up of the stock market. But the internet innovation was mainly a way to gather information. Mm-hmm. So you could search, you could read the New York Times, like on the web. And it was also useful in a social purpose. So people were engaging in a different way. But what we've got today is fundamentally different. AI is not just gathering the information. It can be creative. Mm-hmm. And what this means is the productivity gains could be vast, and actually believe that they will be vast. And we have not seen that yet. So this is something that is coming in the future. So number one, it's fundamentally different. Number two, I think of this as a more diverse innovation compared to the internet. And what I mean by that was that certain companies were really impacted by the internet innovation, and other companies, it's not as big of a deal. But with AI, every single company is impacted. So it's very diverse, and again, much different.
So let me see if I can get this right. In the internet boom, it was the internet boom. It was a very domain-specific thing. But now you're telling me that this impacts profoundly more industries, profoundly more things. So there's broadness to it, and so why is that impactful and that's different than the internet boom?
Yeah, so there are just so many innovations going on within AI. So even within a company, there could be hundreds of different applications of this technology. Whereas back in 1999, it was very focused. So I'm just saying that even if the innovation with AI doesn't work in a particular area within a firm, it will work in another area. So that's what I mean by much more diverse, and that gives me a lot of confidence that this is something really big
What I remember from the 2000s is that the companies were new. At that time, we didn't know Google. We didn't know Facebook didn't exist. It was like pets.com. You have these stories, webvan.com or whatever, and you put .com at the end of the company, and you got an internet stock that was worthwhile. Is that happening? Is that happening today?
Yeah. So this is actually related to my third point, and that is that some of the companies were around. Or at least remember what happened in 2000. So I think that in general, our economy is characterized by companies that are fairly new. And even though they're fairly new, 2000 is not that long ago. Mm-hmm. So we're talking 26 years, and some of the leaders of these companies today, they remember. So they remember what was happening in 2000. So that memory is really important. In 1999, there was nobody leading a company that remembered 1929. They read about it, but they didn't experience it. Mm-hmm. So that memory is really important. And then the fourth point is, given that memory, there is a propensity today to self-disrupt. Mm-hmm. So what I mean by that is, in 1999, they had a business plan and just pursuing that plan. Whereas today, you've got these companies that are willing to take the risk to disrupt their own business. So I'll give like an obvious example is Tesla. So Tesla is not an automobile company. So they believe, and I believe also, that they're on a path to be a robot company. And they're more than willing to self-disrupt. And what I mean by self-disruption is you take a profitable line of business and it becomes less profitable, and you invest in something completely new. So this propensity to self-disrupt is something that's also different. So I think that it is a mistake to equate 1999 with 2026. And let me give you the last reason. The number 5 reason is just to look at the actual fundamentals of these companies. So in the late 1990s, the valuations of these companies went crazy. And often we measure the expensiveness of a company with a price to earnings ratio. And the price to earnings ratios went up very dramatically in the late 1990s. And they went up because the price was going up. Mm-hmm. The earnings really wasn't moving that much. So when the price goes up, the PE goes up. Today's a different situation. So yes, the prices are going up, but the earnings are also going up. So you've got like both things, the numerator, the denominator, there's positive vector for both of them. It just turns out the price is going up more than the actual earnings. So I think that the fundamentals are a lot stronger today also. So this doom and gloom scenario with the bubble bursting, I actually believe that there could be a correction, but it's not the sort of correction from 1999 or 2000. Mm-hmm. This is something, when you look at the underlying data, something that's very distinct.
So you think this time is different?
Robert, every time is different.